Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. So right now, down in El Paso, Texas, one single tech company is pouring $13 billion into basically a patch of dirt.
Right, which is just a staggering amount of money for dirt.
Yeah, exactly. And they aren't building a new city. They're not building, a spaceport or anything. They are building a single data center. So today, we're exploring why the biggest story in the American economy isn't about like a software in the cloud, but this massive physical boom happening right beneath our feet.
It really is huge. I mean, we're talking about a fundamental shift in how the economy operates.
Right. But before we dive into the heavy numbers and all that, we need to define the driving force behind this boom. And it's a concept called CapEx, or capital expenditure.
Yeah, CapEx. It's a term you'll see scrolling across the bottom of those financial news channels constantly. But, it rarely gets a proper explanation for just how fundamental it is to the economy.
Totally. So let's use a simple example for everyone listening. Imagine you own a local bakery. Every week, you're buying flour, sugar, maybe some butter. You pay the electric bill.
Right, the everyday stuff.
Exactly. Those are your operating expenses. It's just the money you burn through to keep the lights on and keep the bread baking. But what if, say, your business is booming and you decide to literally knock down a wall to install a custom-built $50,000 commercial oven?
Oh, wow. Okay, big upgrade.
Right, that oven. That is capital expenditure. It's this massive upfront investment to build physical capacity for your future growth. You aren't buying it for today.
Exactly. I mean, you're not buying that oven just to get through the Friday morning rush. You are betting on the long-term future of the bakery. And if we look at recent data on the broader U.S. economy, well, America is currently buying a whole lot of commercial ovens.
We are buying all the ovens.
We really are. And we're witnessing a massive shift here because, for the last couple of decades, we lived in what you could call an asset-light era, a software era.
Right, where you didn't need much physical stuff.
Exactly. Tech companies didn't need to build massive factories. They just needed smart people typing code in office buildings.
Yeah.
But that era is evolving. We're entering a heavily capital-intensive physical growth phase.
So let's dive right into the hard numbers of this physical building boom, because I feel like people hear a lot of mixed messages about U.S. manufacturing right now. You hear it's booming, and then in the next breath, you hear it's slowing down.
Yeah, it can be really confusing to follow.
So what does the data actually say about where we are?
Well, according to the latest data from the Census Bureau for March 2026, overall, U.S. construction spending hit an annualized rate of $2.1855 trillion.
Wait, trillion with a T?
Trillion with a T. That is up 0.6% from the previous month and up 1.6% year over year. But if we drill down into manufacturing construction specifically, it's sitting at about a $190 billion annualized rate.
Okay, wait, let me jump in here. Because if I look at the historical data, that $190 billion figure is, it's actually down slightly from the peak we saw back in late 2025. I think that peak was around $206.1 billion.
That's right.
So I have to ask, I mean, if it's down from the peak, doesn't that mean the boom is over? Are we already on the downward slope here?
It's a common assumption when people see a chart tick downward. But calling it the end of the boom is kind of a misinterpretation of the mechanics of construction.
How so?
Well, to understand the dip, you have to look at what was driving that initial massive spike. A huge part of it was the CHPS Act. We saw this historic explosion in the construction of semiconductor and electronics manufacturing facilities.
Right, they were building those massive chip plants everywhere.
Exactly. We went from virtually nothing to an absolute frenzy of building these massive multi-billion-dollar fabrication plants.
It makes me think of driving a car on the highway. Imagine you merge onto the interstate and you accelerate incredibly fast, just pushing the pedal to the floor until you hit 70 miles per hour.
Okay, I'm with you.
Just because you take your foot off the gas and stop accelerating, it doesn't mean you stopped the car. You aren't braking. You're just, cruising at a structurally high speed.
That is the perfect way to visualize it. And if we look at the actual engineering of these sites, what's happening now in 2026 is that the heaviest, most expensive phases of those initial mega facilities are simply reaching completion.
The really expensive stuff, like the foundations.
Exactly. Pouring millions of tons of concrete, erecting those massive steel frames, that heavy lifting is done. Now, they are moving into the interior fit-out and tool installation phase, so the raw construction spending naturally normalizes a bit.
So it's not a crash at all.
No, not a crash. It's a normalization at a very high, very healthy level of investment.
Okay, but here's where it gets really interesting to me. If the initial wave of building chip factories is leveling off at this cruising speed, the money hasn't stopped moving. It's just, it's moving downstream.
Exactly. It's shifting focus.
We're moving from building the brains, the microchips themselves, to building the body that houses those brains.
Yeah. And based on recent data from May 2026, AI CapEx is aggressively spreading out. The investment is pouring out of just the semiconductor space and going directly into real estate, power generation, and finance.
It's touching everything now.
It really is. And to give you a sense of the sheer scale here, big tech companies like Meta, Amazon, Alphabet, and Microsoft, they're projected to spend over $630 billion on AI infrastructure in 2026 alone.
Let me just repeat that number for everyone listening. Over $630 billion in one single year.
Yeah. It's almost hard to wrap your head around.
It is an unfathomable amount of money. I mean, when people think of AI investment, they imagine, engineers in hoodies writing algorithms or something.
Right, software.
But the data shows they're actually out there buying huge tracts of land, laying down high-voltage transmission lines, and securing these massive project finance deals. Which brings us right back to that patch of dirt in El Paso.
Exactly. Meta is currently putting together a massive $13 billion financial package strictly to develop a single gargantuan data center complex in Texas. And we really have to explain why it costs $13 billion.
Yeah, please do, because to me, a server is a server, isn't it? Why is it so expensive?
Well, not anymore. You see, you cannot run these next-generation AI models on standard servers in a regular office building. A traditional data center rack might draw anywhere from, say, 5 to 10 kilowatts of power.
Okay, 5 to 10. Got it.
But an AI server rack, which is packed with these advanced graphics processing units, or GPUs, that rack can draw 40 to 100 kilowatts.
Oh, wow. So it's like 10 times the power.
Easily. They are incredibly dense, which means they generate an astronomical amount of heat. If you put an AI rack in a traditional data center, the chicks would literally melt.
They would just catch fire.
Pretty much.
Yeah.
So you aren't just building a warehouse for computers anymore. You're essentially building a massive power substation to handle the electricity, and you're building incredibly advanced liquid cooling infrastructure just to keep the machines alive.
And because of that scale, they're tapping into private credit markets to fund this, right? Can you explain what that actually means for a beginner? Like, what is private credit?
Absolutely. So usually when a company wants to build something big, they go to a traditional Wall Street bank for a loan. But traditional banks move slowly.
Lots of red tape.
Exactly. Lots of red tape. And they have strict regulatory limits on how much risk they can take on a single project. But because the AI arms race is moving so incredibly fast, tech companies and developers are turning to private credit.
Which is what exactly?
They are basically massive pools of money managed by private investment firms. These firms can write $1 billion check much faster than a traditional bank, which keeps the construction moving at breakneck speed.
So if Meta, Amazon, and Microsoft are all moving at breakneck speed to build these massive, power-hungry facilities, that completely shifts who profits from the tech boom.
Oh, absolutely. The winners are changing.
It's like the oldest cliche in finance, right? The guys who made the real fortunes in the 1849 gold rush weren't usually the miners. They were the guys selling the pickaxes and the shovels.
Right, the Levi's jeans and the wheelbarrows.
Exactly. But today, a pickaxe isn't a piece of iron. It's a closed-loop liquid cooling system that prevents a $40,000 microchip from literally melting through the floor.
It's the ultimate pick and shovel play. We are seeing a complete reevaluation of traditional hardware and industrial tech companies.
Yeah.
If we look at the current market analysis, we can actually break down the winners of this AI CapEx boom into 3 distinct tiers.
Okay, let's go through them. Who is tier 1?
The first tier, and the absolute biggest winners right now, are what we call the bottleneck owners.
The bottleneck owners. What exactly makes them a bottleneck?
They manufacture the highly specialized physical components that are in critically short supply.
Give me an example.
Okay, high-voltage electrical transformers. You can't just buy a massive industrial transformer off a shelf at a local hardware store. They require specialized electrical steel and custom engineering. Right now, the lead time to get a new large transformer delivered is often 2 to 3 years.
2 to 3 years? That's wild.
It is. So if you are a company that manufactures power grid equipment, high voltage copper wires, or advanced cooling systems, You are a bottleneck owner.
Because big tech literally cannot turn their data centers on without your specific piece of equipment. You essentially have total pricing power.
Exactly. You hold all the cards. This tier also includes companies providing the critical nervous system for these centers. We're talking about companies like Cisco, providing advanced network switches, or Corning, which manufactures specialty glass and fiber optics.
Right, because traditional copper cables aren't fast enough anymore. Right.
Exactly. Because AI models require massive amounts of data to travel between servers almost instantaneously, traditional copper can't handle the bandwidth over distance inside the facility. You need miles and miles of advanced fiber optics. And of course, companies like Intel, as they push to rebuild domestic chip manufacturing capacity.
Okay, so the bottleneck owners are tier one. They make the critical physical stuff. What's the second tier?
The second tier are the landlords. These are the physical data center operators and their regional power grid utility companies.
So they just own the space.
Right. Their advantage is that they aren't selling a one-off piece of equipment. They're selling guaranteed access.
Sure.
They can lock these big tech companies into long-term, highly stable, multi-year power purchase agreements and leases.
Which is just a license to print money.
Pretty much. They provide the physical space and the massive electrical load required, ensuring a steady, reliable stream of income for a decade or more.
Okay, so that's tier one and tier two. And the third tier, because, in a boom this aggressive, somebody always ends up holding the bag.
Yeah, unfortunately. The third tier are the losers. These are often the middlemen in the ecosystem. Imagine a company that borrows money at, say, an 8% interest rate to buy extremely expensive AI servers.
Okay.
And they are hoping they can rent that computing power out to smaller software startups at a 9 or 10% return.
Oh, wow. That sounds incredibly fragile, like a 1% margin.
It is so fragile. They are operating on razor-thin margins. If demand from those smaller startups fluctuates even slightly, or if the newest generation of chips comes out and makes their servers obsolete overnight, their entire business model just collapses.
Because they still owe the bank for the servers.
Exactly. They are carrying all the financial risk of owning the hardware without controlling the crucial bottlenecks like power or cooling.
That makes total sense. You want to be the one selling the cooling system, not the one taking out a high-interest loan to rent out a server. But, this brings up a huge issue for the rest of us.
The broader economy.
Right. If Meta, Amazon, and Microsoft are all trying to buy these exact same bottleneck components at the exact same time, what is that doing to the cost of raw materials nationwide? I mean, building all this domestic infrastructure is great for American resilience, but we have to look at the side effects on the everyday economy.
Yeah, this is where the macroeconomic picture gets very, very complicated. Let's look at the latest ISM manufacturing PMI for April 2026, which is sitting at 52.7.
Okay, let's pause and translate that really quick. For anyone unfamiliar, the PMI, or Purchasing Managers Index, is basically a massive monthly survey sent to the people running corporate supply chains, right?
Exactly.
And if the score is over 50, it means the majority of them are actively ordering more parts, hiring more people, and expanding. So a 52.7 means the manufacturing growth is very real.
The growth is definitely real, but there's a secondary metric inside that survey called the ISM Price Index, and this measures the actual costs those purchasing managers are paying for raw materials and parts.
Okay, and what did that say?
In April, that price index shot up to 84.6. To put that into perspective, that matches the absolute highest levels we saw back in April 2022, right in the middle of the post-pandemic supply chain crisis.
Wow. So how does a multi-billion-dollar data center in Texas actually affect your wallet as a listener? Imagine you want to add a room to your house because your family is growing. It's a necessary project.
Right, you need the space.
But right as you go to start, you discover the cost of lumber, copper wiring, and plumbers has completely doubled. You're still building the room because you need the space, but it's going to squeeze your finances hard.
That is exactly what is happening on a national scale. And according to recent economic analysis, there are broader political and economic factors amplifying this. Well, when you look at the data, trade policies under the current Trump administration, specifically the implementation of new tariffs, are being cited as a major amplifier. When you combine those tariffs with companies actively moving their global supply chains back to U.S. soil, plus this immense, insatiable demand for raw materials to build AI infrastructure, well, you get a textbook case of what economists call cost-push inflation.
Let's clarify the difference there, because it's important. Most people are familiar with the demand-pull inflation, right? That's when everyday consumers have too much money and they're out there buying tons of TVs and cars, which pulls prices up.
Right, too many dollars chasing too few goods.
Exactly. But cost-push inflation is different. Prices aren't going up because everyday consumers are spending wildly. Prices are going up because the fundamental building blocks of the economy, the steel, the copper, the labor, are dramatically more expensive to procure.
Yes,
Manufacturers are forced to push those costs onto the buyer just to survive.
exactly. The manufacturing recovery is robust, but it is incredibly expensive. And this creates a major headache for the Federal Reserve.
Because of interest rates.
Yes, it puts intense pressure on interest rates. Usually, if the broader economy feels a little tight, the Fed might step in and lower interest rates to give consumers a break. But they can't easily do that when the physical costs of building the country's new infrastructure are structurally driving prices through the roof.
If they lower rates too soon, they risk pouring gasoline on an already hot inflationary fire.
Precisely. Which means for investors, the playbook have to adapt. You can't just throw money at a company because they use the word AI in their press releases anymore.
Right, those days are over, so what do you look for?
In a high-cost environment driven by cost-push inflation, you have to favor companies that generate strong, reliable cash flow. You need companies that have the pricing power to pass those rising costs onto the end consumer without losing business.
Because if a company can't pass on the cost of that expensive copper wire or that specialized transformer,
Their profit margins are going to get absolutely crushed. That's the ultimate takeaway for navigating this specific market dynamic. The companies that thrive will be the ones whose products are so physically essential, like our Tier 1 bottleneck owners, that their customers simply have no choice but to absorb the higher prices.
okay, let's bring this all together. We started by defining CapEx, which is the money spent on huge, long-term physical investments. And what the data clearly shows is that America has definitively re-entered a massive, capital-intensive industrial era.
We really have.
The real money in the artificial intelligence revolution isn't just floating around in the software cloud. It's literally buried in the ground in high-voltage copper wire. It's humming inside massive cooling systems. And it's drawing immense power inside multi-billion-dollar data centers in places like El Paso.
Yeah, we are building the physical body for the AI brain.
Right. And it's reshaping the manufacturing sector, reviving old-school industrial tech companies, and, as we discussed, keeping inflation much hotter than we might like.
It's a profound structural shift. And, as we wrap up, it raises a critical question, something for everyone listening to really think about.
What's that?
Well, if the entire future of artificial intelligence, which is the technology that is supposed to define the global economy for the next century, if that depends entirely on our physical ability to generate electricity, secure land, and supply raw materials like copper and glass,
Yeah.
are we moving toward a world where the next great superpower conflicts aren't fought over digital data or code, but over the physical control of copper, land, and water rights?
Oh, wow, that completely flips how we tend to think about the future of tech. We assume we are moving into a purely digital future, but we might actually be returning to a fierce competition over the most fundamental physical resources on Earth.
It's a very real possibility.
That is definitely something to chew on. Don't forget to subscribe and hit that like button.